Welcome to the deep dive. We've sifted through, well, quite a pile of sources for you today. Think news alerts, analyst reports, those crucial SEC filings, all from the last 24 hours or so, around October 23rd, 2025. Our goal here is pretty simple. Give you a fast, informed look at where the market's really focusing, pulling out the big corporate moves, but also those quieter details that matter.
That's right. We're trying to cut through the noise, find the signal. And when we boil it all down, three big stories really jumped out today. First, you've got massive shakeups in big media, some unexpected events, some huge M&A buzz. Second, some really targeted, confident analyst moves in fintech. And third, and this is maybe the most important for anyone holding individual names, some pretty serious, sometimes buried stuff around corporate governance and legal risks popping up.
Okay, let's kick off with that media drama then.
Yeah.
Because it was really a tale of two companies, wasn't it? You had Netflix, nflx reporting Q3 earnings, and the immediate reaction, ouch, down like 6% right away in after hours.
Yeah, it looked rough on the surface. EPS came in at $5.87, but the street wanted, what, $6.87? And the operating margin, 28%, that missed their own guidance of 31.5%. So yeah, optically not great.
But the interesting part is why, right? It wasn't the usual suspects like subscriber numbers or content flops.
Exactly. The entire miss, like every cent of that gap, it boils down to one single thing, a very large, non-recurring tax charge.
And large is the word. We're talking approximately $619 million, specifically tied to Brazil.
$619 million. So the challenge for you as an investor is, do you trust that non-recurring label when the market's hammering the stock right now?
Yeah, it creates instant volatility, doesn't it? Over a technicality, really. Meanwhile, the other big media story, Warner Bros., Discovery, WBD, totally different vibe. Soaring, basically, on M&A talk.
Right. WBD came out and said they're looking at strategic alternatives. And they were clear that includes possibly selling the company.
And the market, or at least the analysts, they jumped right on that. Benchmark, for instance, hiked their target price dramatically from $18 up to $25. That's almost 40%.
Yeah.
And they kept their buy rating.
Yeah, huge conviction there. Guggenheim also bumped their target up to $22. You don't see those kinds of sharp upward moves unless analysts see real underlying value about to be unlocked, potentially.
And this is where the rumors start flying, I guess.
Oh, yeah. The specific chatter is around David Ellison, the CEO of Skydance Media. Reports are saying he's teaming up with a big private equity player, maybe like Apollo Global Management. And they might be putting together a proposal, a massive one, like $60 billion massive, to buy WBD.
Wow, $60 billion.
Yeah.
And the fact that WBD's own statement mentioned getting unsolicited acquisition interest,
Yeah.
well, that just adds fuel to the fire, doesn't it?
It certainly gives those analyst upgrades some immediate backing. Yeah.
Okay, so a potential $60 billion deal versus a $600 million tax hiccup. That perfectly captures the kind of volatility in media right now. Let's pivot to fintech. Here, the analyst upgrades felt more grounded in actual performance, not just rumors. Let's talk Block CQ.
Yeah, Block saw some really high confidence upgrades. KeyCorp, for example, just went straight to strong buy. That's a big call, signals they see a lot more upside.
Right, and Jefferies followed suit, raising their price target from $90 to $95. What's driving that optimism? What are they seeing?
They pointed specifically to strong momentum in gross payment volume, GPV. And for anyone following Block, you know GPV is basically the lifeblood, right? The total amount of money flowing through their systems. So strong GPV suggests they're grabbing market share, maybe handling the current economic climate better than others.
Okay, and Affirm, AFRM, also had a bit of a positive move.
Yeah, a smaller bump, about 3.2% up on October 21st. The catalyst there was expanding their partnership with Wayfair, the online furniture retailer. So for Affirm, it's still very much about growing that network of retail partners.
Got it. Now let's bring in SoFi Technologies, SoFi, because this is where we get into that crucial difference between SEC filings that are just transparency and ones that might be alarming.
Exactly. So the filing shows SoFi's EVP, Kelly Q, sold shares, about $284,000 worth. And, insider selling can definitely spook investors sometimes.
Right. So how do we know this isn't a sign of panic from the executive suite? What's the key context here from the Form 4 filing?
The context is everything. This wasn't her waking up Tuesday and deciding to sell. It was pre-planned. It was done under what's called a Rule 10b5-1 plan, which she adopted way back in May 2024.
Okay, explain the 10b5-1 thing a bit more. It's like setting up automatic trades in advance.
Precisely. You set up a schedule for selling stock months, sometimes over a year, in advance. It removes the ability for the insider to time the sale based on any secret, non-public info they might have later. It basically proves the sale was decided long before whatever news is happening now.
Okay, so planned, scheduled selling. That makes sense. And just for balance,
Yeah.
there was actually some pretty bullish stuff on SoFi this week too, right? Like that Motley Fool piece predicting it could be bigger than Capital One by 2030.
Yeah. So you've got this mix of scheduled, transparent selling alongside some very long-term optimism. Now, we just talked about insider sales that are, well, above board because of that 10b5-1 rule. Let's contrast that with filings that hint at something less transparent, maybe even dangerous for investors.
Yeah, speaking of things that should make investors nervous, let's jump into that third section, corporate governance and legal risks. LifeMD, ticker LFMD, they're facing a federal securities fraud class action lawsuit filed just October 22nd.
That sounds serious.
It is serious. And what's really interesting, or maybe alarming, is what the lawsuit focuses on, is about basic operations. The claim is LifeMD misled investors, specifically between May and August of 2025. They allegedly hid critical problems in their virtual obesity management business, the RexMD part. Okay, so what were these hidden operational problems that tanked the stock and led to this lawsuit?
According to the suit, they failed to disclose two huge things. One, big increases in how much it costs them to acquire each new customer. That's customer acquisition cost, or CA. And two, much higher refund rates than expected for their weight management program.
Right. And in plain English, for a business like that, if your CAC is secretly soaring and people are demanding refunds,
Your whole model breaks down. If it costs you more to get a customer than you'll ever make back from them, the business just isn't viable. That's why it's potentially securities fraud. The allegation is they hid information that showed the core business wasn't working as advertised, and the stock dropped over 44% back in August when some of this started coming out.
oof, okay, that's a stark contrast to, say, Carvana, CVNA. They announced a move that sounds more defensive, joining the LOT network.
Yeah, that's a proactive governance move. The LOT network is basically a group of companies agreeing not to sue each other with patents acquired from patent trolls. It's about protecting innovation from excessive litigation. So Carvana joining is them trying to shield themselves, which is generally seen as a smart defensive tactic.
Interesting. And we saw that same Rule 10b5-1 plan pop up again, this time at Duolingo, DUOL. Similar to SoFi.
Correct. Severin Hacker, the co-founder and CTO, sold about $3.1 million in stock. But again, the Form 4 filing confirmed, pre-planned trading schedule adopted back in September 2024. So for you listening, spotting that 10b5-1 detail is really key. It changes how you interpret insider selling dramatically.
Okay. And quickly on the health sector governance moves.
Yeah.
Eli Lilly, LLY, had directors getting stock.
Yes, but again, context matters. It wasn't them buying shares on the open market because they think the stock's cheap. It was part of their compensation, distributed under the Lilly director's deferral plan. More of an internal accounting thing, really.
Right, not a bullish signal per se. And Novo Nordisk, NVO, their recent stock dip was tied to governance changes.
That's right. The decline seems linked to uncertainty because the Novo Nordisk Foundation, which is the majority shareholder, wants to appoint new directors to the board. Anytime a controlling shareholder starts shaking up the board, the market tends to get a bit nervous until the new direction or strategy becomes clear. It signals potential shifts or even power struggles.
Okay, that tees up our last section nicely. A quick snapshot of retail, apparel, and real estate. Are these sectors running on analyst hope or facing more fundamental headwinds?
Well, we've got some immediate dates to watch. Deckers Outdoor, DECK, and AppFolio, APPF, both report Q2 earnings today, October 23rd, right after the market closes. And Wall Street seems to have pretty high hopes for Deckers, expecting around 1.58 cents in EPS and $1.42 billion in revenue.
Okay, deadlines noted. In apparel, Lululemon, LULU, got a bit of a boost. An upgrade.
Yeah, a technical lift, you could say. BNP Paribas Exane moved them from underperform up to neutral. The thinking seems to be that the recent stock drop was maybe a bit overdone and it found some support.
But not all good news in apparel. Nike, NKE, is dealing with a lawsuit.
Another legal headache. This one's a gender discrimination and retaliation suit brought by a former executive. Adds another layer of risk, beyond just sales numbers.
Right. And shifting to home goods, we know that whole sector's been under pressure. Inflation, tariffs, consumer pullback. But La-Z-Boy, LZB, actually got an upgrade.
A slight one, yeah. Zacks Research moved them from strong sell up to hold. but you have to see that in context. It might just be that the valuation got so low it hit a floor. It's probably not a sign of massive confidence returning to the whole sector, especially with others like Lovesac and RH still facing those headwinds.
Makes sense. And finally, rocket companies, RKT, in that real estate space. What's the latest there?
Post-acquisition moves, they're doing more layoffs after buying Mr. Cooper. So the theme there is clearly about cutting costs, trying to find those synergies after the merger. Rationalization, basically.
Okay, so if we zoom back out and look at everything we've covered from the last 24 hours, what's the big picture for the listener?
Well, I think the major takeaway is this sharp divide, right? You had the huge speculative excitement around Warner Bros., Discovery possibly being sold, contrasted with the very real, quantifiable operational problems revealed in that LifeMD lawsuit, just night and day.
And it really highlights the need to understand why things are happening. You've got to distinguish between those planned, transparent insider moves like the 10b5-1 sales at SoFi and Duolingo, which are sort of procedural.
Right.
Versus the potentially catastrophic undisclosed risks like LifeMD allegedly hiding their high customer costs and refund rates. That's what led to that 44% stock crash.
Exactly. Today's news flow really shows that risk isn't always about the big macro picture. Often it's buried in the specifics of corporate disclosure, or lack thereof. So when you're looking at companies, how much weight do you give those positive analyst upgrades like we saw for Block or Lululemon compared to the immediate hard risks you might find in an SEC filing, like with LifeMD? And maybe even more subtly, are those quiet governance shifts, like the potential board changes at Novo Nordisk, actually a better indicator of long-term risk than whatever big headline just hit the wire? Something to think about.
Definitely food for thought. Thanks for joining us for the deep dive. We'll catch you next time.